Welcome to Team 12.1 Hotel Medusa. This is Nick. Nick was in charge of all our marketing decisions. Introducing Jaffer, who was in charge of all our refurbishments and renovations. Elio was in charge of keeping track of all the decisions made by the group. And Charlie, our channel manager. And finally, Alessandro, our sales manager. Welcome to our RevSim analysis of our Hotel Medusa. Hotel Medusa is a business hotel, and one of the reasons we decided to be a business hotel is because we saw there's a high demand for business travelers during the week, and this was an opportunity for us to capture more profits. Hotel Medusa consists of 250 bedrooms. We offer a conference center, a business center, restaurants, as well as other services. Our positioning in the market was to attract business travelers during the midweek. This was our main target group. However, our target market in general were business travelers, groups, and corporate businesses, as they would be the most beneficial for us. Finally, our pricing strategy was to match the markets whilst delivering higher quality compared to our competitors. This way we would ensure we would maintain consistency during the different months.
Hello, now we will do our analysis and findings for the Hotel Medusas. We will analyze our price, marketing and refurbishment strategy for the whole year. In our first quarter, in the month of January, we decided to keep a price that was quite low, that was coherent with our position in the market, so we have decided to be a 4-star hotel, a 4-star business hotel. But unfortunately what happens is that the competition decided to have a really high price compared to us. For this reason we had an high occupancy index and a low ADR index. The following month, in February, since our price was too low, we decided to increase our prices. But the competition decided to have lower prices than us. That has bring us to have a really low occupancy index and a really high ADR index. The month of March was the month where we started understanding how to manage our price strategy, and we decided, even if the occupancy we forecasted was higher than in February, to put a price a bit lower than in February. And this was the month where we get the closest price to the average. And in fact we had almost 100% for our ADR index, and our occupancy index was over the comp set, as well as our RevPAR index. For April, since we wanted to increase our ADR index and we forecasted an even higher occupancy, we decided to increase our price. But unfortunately, our occupancy was lower. At the beginning, our strategy was to keep weekdays price a bit higher than weekend prices. That's why we wanted to be a business hotel, and we were supposed to have an higher occupancy during weekdays. Unfortunately, what we can see from this graph is that in weekends, the occupancy was higher than weekdays. Our marketing strategy was to spend at the beginning from between 3 and 4% of our revenue, and that's what we did. And the other strategy was to invest mostly in segments where we didn't have an higher occupancy, such as premium room, packages, qualify and guarantee. Our refurbishment strategy was to start doing refurbishment at the beginning of the year. Since we were a business hotel, we decided to invest in a business center, and that's why in the first 2 months we had a really low net profit and a quite low total revenue.
For the second quarter, starting in May and June, we forecasted a higher occupancy rate. Therefore, we decided to increase our prices. Even though our prices were lower than the average prices for these months, we had a lower occupancy rate. We believe that this is due to our low spending in refurbishment. However, due to our good ADR, we managed to increase our revenue per available room. For the months of July and August, we further increased our prices. However, as our competition decided to decrease their prices, we saw a higher increase in our revenue per available room. Since we noticed that our occupancy during the weekends was higher than the occupancy rate during the week, we decided to increase our prices for the weekends and increase our revenue. Since we realized that our marketing expenses were very low, we finally decided to increase them by around 6 to 7%, which led to an increase in our transient occupancy.
In the second quarter, we decided to spend a bit less money in refurbishment. That's because we spent a lot of money in the first quarter. Because of this, we got a really high net profit and revenue and GOP. For the third quarter, our price strategy was continuing the same. So we forecasted our occupancy and then we decided where to put our price strategy compared to our competitors. In September was the month where we get the best rate compared to the average price. In fact, it was really close. As you can see, our ADR, occupancy index, and RevPAR index, it was in the month where they were the closest to the composite. In October, we did a mistake. Unfortunately, we forecasted a wrong occupancy. We forecasted 90% occupancy. And that's why we decided to increase our price that high. In fact, as you can see, our price was the highest compared to our competition. And this has bring us to a really high IDR and really low occupancy index, and our RevPAR have suffered from this. For the month of November, we had the chance to get our group, and that's why we make a decision, and it was to keep a lower price than in October. But then we realized that was not a good decision because it was better to have an higher price since we had already sold a lot of rooms. Our marketing strategy for the last quarter was to spend a bit less compared with it in the second quarter. That's because we forecasted a lower occupancy. Since we noticed that our quality was much more lower than our competitors, we decided to increase our refurbishment expenses. As you can see, in fact, in October we had a lower net profit. In November we increased our GOP and our net profit thanks to the group that we took.
And now we talk about the required for the proposal. And to provide the price, first of all we need to calculate the minimum rates, and we need to find out how many transient room displayed and forecast the occupancy rate for the following month. Then we need to check out the average daily rate and the variable cost from the past data. And then we can calculate the price that we offer to the groups. Also, we need to to offer the price, we need to consider other expenses as well, such as the facility and the service the group needs and the package they want. For example, on July, we can offer a really low price for a group, but they plan to use the facility from other hotel, and they didn't want any package. So we decided to put up our price because there's less profit. And on November, we got an RFP that's improved our market index a lot, and as Nick mentioned. According to that, we decided to spend less on the marketing for the groups because we already have enough occupancy rate.
I'm going to be talking about the summary of the year of our Hotel Medusa. What I'm going to be firstly talking about is occupancy. So as we can see on the graph, our occupancy was quite consistent, and it even had more of a rise up after the month of March until the month of August, after which there was low season where the occupancy started to decrease until the month of November, in which we obviously have received the RFPs. And as we can see, it was an unnatural bump on both the occupancy indexes and as well as market penetration indexes. So here we can see that on the market penetration index, we can see that our group discounted and transient rates kept going consistently, obviously with some certain volatility depending on our competitors. However, as we have received the RFPs, here we can see the natural bump of the groups, which has obviously also increased our occupancy to the natural level, after which we have been brought down to the baseline. Most of our revenue, which was 91.5%, came from the rooms, and all the others came from other departments. Our overall marketing expenses ended up at 7.8%, which is certainly slightly bit higher than we intended to spend at the beginning of the simulation. Considering the rooms, our most profitable room type was bar standard, which accounted for 25.73%, and our second highest was 15.93%, which means our marketing investment was beneficial. Talking about the market indexes, here we can see that over the whole year, our ADR index was right above the baseline, which was right above 100. Our RevPAR index was just below the baseline, which is right under the 100, as well as our occupancy index, which was a little bit lower. As we can see, that means that several of our decisions were inefficient. Some of them, including the marketing investment, it was a little bit lower at some points where we should have invested, as well as our refurbishments. What we think the problem was that sometimes we put up the prices a little bit too high over several months, and our quality was not sufficiently high enough compared to our competition. Now I'm going to be talking about the variance table here. As we can see, our rooms and other revenue that was forecasted was about $1 million. However, our actual revenue that we have received was quite much less than $1 million. As we can see, therefore, the variance was about minus 16%, which is considerably high. That is for the reason that our marketing expenses were too low at some points, as well as our refurbishments and our quality at one point was too low with high prices, and at one point it was too high with low prices, which was certainly inefficient. Talking about the operations, the similar thing happened here. Our occupancy was forecasted to be about 60%. Our rooms sold were about 4,500, but the actual was way less. We had rooms sold 4,000, and our actual occupancy was 52%, which happened for a similar reason, due to our inefficient use of the price allocation, as well as our inefficient marketing spending.
From our analysis and our findings, these are the short-term and long-term recommendations we have come up with. Okay, our first recommendation was to maintain consistent pricing. As our pricing wasn't so consistent, this led to a bit of confusion in the market, and this also makes it very unattractive for guests, as they're unsure where we're placed and our positioning in the market. Furthermore, because of the fluctuating prices, our indexes were also fluctuating a lot, and this wasn't very healthy for our hotel. In addition to that, our short-term marketing should have been improved. For example, when we had the group request in November, we should have increased our marketing more towards transient guests and not towards group. This way we would have been able to take full opportunity and the capacity in the market. And finally, we should have also continued our small renovations and refurbishments after every month, as we only did this for the first quarter and the last quarter, and wasn't so consistent. In terms of our long-term recommendations, we had several. First, we found that we should have had more investments, as in the first quarter, we only invested in a business center. When we found that we should have later invested in a gym as well, as a gym facility is important for a four-star hotel and is expected of a four-star hotel for many business travelers, and is most of the time a necessity. Furthermore, our investment in marketing was too low in the first quarter. This didn't create enough awareness of how much quality our hotel had. And because of this, we were perceived differently from what we actually were. In addition to that, 60% of our bookings came from direct bookings, when most or more should have come from GDS or from OTAs, as this would have also increased our occupancy and made our hotel more visible in the market. Last and not least, our return on equity was lower at 6.8% when we needed it to be at 8%. This could be changed next time by having greater financial leverage or better profit margins.